Sometimes the direction may be right, but the path can be very volatile and difficult to manage.
That's actually been one of the key reasons how we came across these more specific long volatility strategies.
We've seen sharp sell-offs, sharp rebounds. Start paying attention to things like the VIX.
And so the VIX index and volatility more broadly can also be a measure of how much people are willing to pay for insurance in order to protect themselves.
Hi, Daniel. Welcome, and thank you very much for joining me today.
Hi, Jade. Thank you very much for having me.
You are based in Switzerland, and your work has been deeply focused on global macro, derivatives, and long volatility strategies for many years. So I think this is a very timely conversation. In such an uncertain market, in my own experience, sometimes the direction may be right, but the path can be very volatile and difficult to manage. Like here at the beginning and here at the end, maybe the beginning, the end, you can predict, but here the path can be very volatile, so it's difficult to manage. Can long volatility or volatility strategies help to smooth the path?
That's right. No, that's actually been one of the key reasons how we came across these more specific long volatility strategies many years ago, because we've been investors in global macro strategies, so macro trading strategies, for even longer. And I mentioned that because it's very central to macro trading strategies to use volatility instruments, to use various forms of options in order to implement their global macro themes and strategy. So that's independent, whether it's in interest rate, in equities, in commodities. They're usually fundamentally driven, the macro funds, and they have a certain thesis or theme that, for instance, for geopolitical reasons or political fiscal reasons, monetary policy reasons, a certain asset might shift from here to there. Now, as you mentioned, the length, the volatility of this shift from here to there, what they anticipate, can be very much key in terms of what result they actually achieve, and also in terms of what risk they actually face. And so for macro strategies, they often use options in order to it's like having a better racing car. It's like to have a more nuanced, a more technically agile racing car with better brakes, with better aerodynamics, right? And so having these options in your toolkit, you're still the goal is still getting from here to there. So from current price to the anticipated price. However, you're getting from here to there in a more in a better way, hopefully, in a more targeted, in a more technically sophisticated way.
Yes, you are right. And why I raised that question is because, when the path is very volatile, it really affects the decision making, So can you hold those assets? Can you still doing the conviction investment during that very difficult period of time? So I think if at that time, if I can buy an insurance, then I can do my thing. Like I can predict the direction and hold the assets until where I think it's going. So I think that is very important. It's psychologically important.
Oh yes, very much so. Very much so. And then, that's actually irrespective of whether you're facing more retail type or affluent investors or family offices or other very institutionalized investors, because psychology, it's usually a chain, right, of decision makers. And so psychology is always involved on all levels, right? Whether that's with the ultimate clients, the end client, whether that's with the institutional intermediary sitting in between, whether that's on our side, or whether that's on the hedge fund side, right? So the hedge fund portfolio managers we entrust with our money. Psychology and the mental aspect is part of all of these levels. And yeah, you're absolutely right. So sleeping well, right, as the expression goes, is not just for comfort reasons. It can actually be key factors in order to stay with the long-term strategy, to stay focused, to do the right thing and not do any missteps at the wrong time. So yeah, it's very much a core piece.
Yes, correct. I experienced a lot, not only sleeping well, but also capturing the rebounds. We've seen a lot of quick sell-offs and very fast rebounds, during a short period. So I think buying an insurance is helping investors a lot in current market. Like I know some people just long VIX futures. That's a very simple way to buying insurance, right? As investors, we've all felt over the past few years that markets have become very much fragile, reactive, and difficult to navigate. We've seen sharp sell-offs, sharp rebounds. And interestingly, during these periods, even people outside of finance start paying attention to things like the VIX, or so-called fear index. What's behind the VIX? VIX stands for Volatility Index. But I think many investors still don't really understand what volatility actually means in finance. So why the industry uses volatility as such an important way to think about risk. When investors talk about volatility, what are we actually referring to?
I mean, volatility is kind of it's kind of a weird beast or animal because it's like two faces. So it's both directly attached and very much intertwined with the classic asset classes we all know, equities, bonds, foreign exchange, as well as commodities. Within as being part of the options related to these asset classes. So it's a key component of pricing and valuing option prices on pretty much everything, on pretty much anything. At the same time, and that's the other side, I want to point to it's also you can call it an asset class in its own right, right? So it's a market in its very own right. And there is many participants. It's huge in terms of size. So basically all major global investment banks as well as hedge funds are participating in that global volatility market. It's across regions, across asset classes, as said. So in various forms. It's also part of swaptions, of equity-related options, equity index options, single equity options, both call options, put options, and various exotic options actually, as they are called. So even more complicated forms of options.
Wow, that is a very technical answer. I think you mentioned a lot of options. Volatility become tradable, maybe because options markets developed. Can I say that?
That's right. That's actually how volatility became tradable and measurable, right? I mean, taking a step or two back, volatility in and on itself just pretty much is another word for variance, for ups and downs, for variation, for swings, for change, and by means of being related to change, it's also related to uncertainty, to risk, basically price swings, right? In one word. But then in order to really be part of the financial markets, to be tradable, it's really a key component of options and option prices, because with options, if you buy an options, you have the right but not the obligation to buy or sell a certain asset at a defined price, right? Being the strike price. So it's a right but not an obligation. And having this right becomes more valuable, all else equal, the more volatility or the more swings, the more price variation there is, because your potential gains then could be larger, the larger the swings are. And that's the relation between volatility as a concept, so meaning price changes on the one side, and actual financial instruments, options more specifically.
Yes. So thanks for the financial market development, so we can have more assets to trade. And at the very beginning, I mentioned the VIX, so the volatility index. That's so-called fear index, right? So I want to ask why the industry uses volatility as such an important way to think about risk. Why use volatility to describe risk?
Right. I mean, as its volatility is directly related to the price swings, right? So that usually the larger the price swings, the bigger the perceived risk is of a certain financial market, of a certain financial instrument. So that's the key relation. And then a bit more technical, you can also look at options as being kind of an insurance instrument, right? Because if you buy put options, for instance, you're effectively buying protection to the downside. And so the more demand there is for these put options, so for these downside protection instruments, it's like there is more demand for insurance, right? And so people are willing to pay a higher insurance premium then. And so the VIX index and volatility more broadly can also be a measure of how much people are willing to pay for insurance in order to protect themselves.
Like buy options. So yes, that's a normal way for some people like in the traditional markets to use the derivatives to protect their portfolios. I know you have lots of ways to play around the volatility. We can talk about it later. We have the risk measure as volatility. And also, we can trade volatility through the derivatives markets. So what are the key characteristics of volatility as an asset? I mean, how is it different from traditional assets like equities or fixed income?
Right. Right. It's essentially like a second dimension attached to these traditional, well-known asset classes. So whether it's equity, fixed income, commodities, etc., it's like another dimension. And so it's really different by almost always being attached to these base asset classes, and then also by being very much uncorrelated, in various cases even negatively correlated to these asset classes. And I think that's a really interesting feature also as a use case. And maybe we are jumping ahead here, but just as a one maybe characteristics here. So as volatility often rises when markets are in trouble, when markets are on the decline, when the perceived risk is actually increasing. So being long volatility or owning this volatility, owning this option can actually be a really interesting way to diversify, right? And especially now in times, and we've seen now multiple years of significantly positive correlations between equities and bonds, which used to be, the 60-40 and the traditional form of diversification for traditional investors. So I think that should actually be or make volatility even more interesting as a way to diversify various portfolios.
Yeah, you are right. It seems like the traditional 60-40 equity bond portfolio nowadays have a question mark on it. Like, is it still negative correlation between equities and bonds, or maybe they're just move in sync? Yeah, I think during the past 5 years, lots of people ask that questions. Are those two traditional assets or moving in sync? Even the past several months, we can see. Yeah, you are right. So you just mentioned that's why volatility is a unique asset, because volatility behaves differently from equities and bonds. They are moving different directions. So within that broader framework, how would you position long volatility as a strategy, and what does fundamentally try to capture?
Well, I think there is an important distinction to make already at the very start. So I think you said long volatility, right? You didn't just say volatility, because when volatility is mentioned standalone, it often means also arbitrage strategies, or actually for retail. For retail investment, typical retail investors, structured product type investors, it often actually means being short volatility. So it's just at the opposite end of the spectrum. So it's selling insurances, selling volatility in order to earn a premium, right? An insurance premium or volatility premium over time. Now, long volatility is willing to buy insurance, to pay a certain defined amount of premium, of insurance premium, in order to own this protection or this insurance, in order to profit from either increasing or already elevated price swings in a given market, right? And so I think this is really kind of an interesting concept, because like you can look at real estate as an asset class, you can look at cars as an asset to buy, and then the insurance, so whether a house insurance or car insurance, is very much related to it, but it's a different animal. It's a different form of asset and financial contract. And so owning all this insurance basically gives you optionality, right? You know, you have a defined downside. That's the premium or price you paid for the insurance. That's the maximum you're to lose, just conceptually. And but you have a fairly high, if a certain event happens, or a scenario strikes, a crisis strikes, you typically have a significantly higher potential upside.
Yes, you're right. Thanks, Daniel. Actually, I should ask you, what is long volatility first? So volatility is risk in the financial market. So when we long volatility, we take advantage of risk. So why you take advantage of risk? Probably you want to earn money during a period of stress. Also, maybe you want to protect your portfolio. That's the position of long volatility strategy. I think so. So volatility can protect your portfolio and can earn returns as well. And also, I think because Daniel just mentioned nowadays the equities and the bonds are moving in sync. So can volatility be a diversification in a portfolio right now in the current market?
Yeah, especially, I mean, long volatility particularly is one, I mean, it's all relative always, right? There is no perfect black and white. There is ultimately in financial markets in the very long term almost no certainty, if you're very right, frank. However, I think long volatility is one of the more reliable, relatively speaking, one of the very reliable and most reliable instruments and use cases in order to diversify, as you said, because of its negative correlations to almost any assets. That's also the primary use case we see with many clients and people we on regular exchange. So that's really the diversification and protection use case, right? However, on top of that, we also think that in a world, and we already thought so, you know, and started thinking so in a more strategic way since about 2018, 19, that often volatility tends to be underpriced for different structural reasons in markets. So not all forms of volatility, but at any given point in time, specific forms of volatility for structural reasons. And those structural reasons include the way the financial system and the banking system and the wealth management system are actually set up, where often you might have heard of the so-called principal agent problem or principal agent issue in financial theory and markets, where often wealth advisors and banks, and they're incentivized to sell products to clients with a very seemingly stable return stream, which are positive most of the time. however, which might or might not be selling volatility to one degree or another. And these forms of incentives in the financial market can actually lead to lower volatility prices, which can then be potentially be attractive for market participants like us being on the long side of volatility.
Are you talking about the bank products named like FCN?
I mean, I don't have any specific products in mind. However,
Yes.
I think it's well known in the volatility space that, for instance, a lot of volatility supply, so-called volatility supply to the market, is actually generated by structured product flows. So
Yes.
structured product is set up mainly for maybe retail investors, affluent investors, but actually quite often also for institutional investors, where they want to earn some steady return stream. And I'm I'm saying steady in quotation marks here, because ultimately, it often does not turn out to be that steady in the long term. But so you're basically generating this return stream by selling insurance, by selling volatility, and obviously, there is a price coming with this. There is a risk attached to this, and we think it's sometimes selectively underpriced because too many people are selling volatility at the same time. And so it can be attractive to actually take the other side, to buy this volatility.
Yes, you are right. Actually, in the current markets, retail investors have more chances to gain exposure to derivatives. Sometimes they buy some products, like I mentioned, FCM from the banks. In stable markets, these products can generate attractive carry or yield, but during periods of stress, they can experience very large drawdowns. But most of the retail investors, and they even don't know, they already gain exposure to the derivative markets. That's why I think the derivative market is more and more important nowadays, because there are lots of finance institutions by using all those derivatives, options or futures behind those products. That's why I think it's very important to let our audience to understand clear what is the basic concept of the volatility or options. Thank you for mentioning that. So maybe we can talk about it later when we talk about the scenarios, how to use the volatility.